Hey folks, welcome to verifiedinvesting.com. My name is Gareth Soloway here to deep dive into the S&P 500. We just hit a new all-time high on the S&P. The big question is, have we cleared hurdles? Is the market going to be rallying significantly higher now? And the question again, we'll look at the charts for the answer. This is very important. It's all about the charts and where are the resistance points. So let's dive right in here to the S&P 500. We're going to start with no trend lines whatsoever, and you're going to watch me create what the levels are, right? And basically what we do here in technical analysis, folks, is we connect major pivots, we look for parallels, we look at Fibonacci. These are standard things. We're not going to bring in a bunch of crazy indicators because, to be honest, you get paralysis by analysis in that scenario where, again, it's just too much to handle. So when we're looking at the S&P, the first thing we notice is that on the daily chart, we did close at a new all-time high on Friday, October 24th. Now, again, that took out this wide range red candle. Now, in technical analysis, anytime you're inside of a wide range red candle, the bias remains slightly negative unless you get above that. That happened on Friday. So that negates the power of this candle. And again, this is very standard stuff, folks. So it's not that I'm creating it or I'm making it up. Like, you literally go to any technical analysis handbook and it will show you these things. I'm just giving you this information based on probabilities and chart formation. So what we know is that the bearish aspect of this chart has been negated. So like I said at the start, the question now becomes, are we going to just zoom up? Are we headed to 7,000? Are we headed to 7,500 on the S&P by year end, 8,000 by next year, or 9 or even 10,000 on the S&P? And the short answer is we don't know 100%, but what we do know is there's a ton of resistance just above current price. So let's go look and take a look at the resistance points. So first things first, notice how all of these highs basically are in alignment. And this is something my eye just picks up, right? So if you just look at this and let's just test it out, let's just see, are all of these highs in alignment? And what we could see is the answer is yes. So essentially going back to July 3rd, every time we come up to this area, we get rejected, up, rejected, up, rejected. And here we kind of hugged it, and then we had the big fall, right? Well, guess what? We've now moved up, but we're not at the resistance point yet. That would be an area where I would think the market can potentially hit some resistance. What price point is it? Well, again, it's a daily ascending trend line, so it depends on which day we hit it. But right here would be around 68.75. Well, we closed at 67.92 on Friday. So that gives us about 80 points of potential upside. That's just over 1%. So there's 1% approximate upside in the S&P. Now, what we do is, as a technician, we go from being in the near term, and I love to zoom out and try to find the bigger trend lines. And I do have some that we've looked at before, right? So, for instance, here's another one right here. If we zoom out to the October of 2023 low, and we take a trend line there and we drag it through the August major correction drop right there, and we bring it up, look at what we start to get, right? We're now getting a confluence, right? So you have this low from October of 2023. You have this low right here in August, and we bring it to this low here in our January of 2025 correction before we moved right back up. And we basically have a secondary trend line now that is merging with that original one. And remember, in technical analysis, one trend line is okay, but really you want two, three, you want essentially factors. Now, factors could be a Fibonacci retrace, a Fibonacci extension, it could be a gap fill, it could be a double top. Those are all potential factors, but also trend lines, right? If you have one shorter term trend line and you take another one and they intersect, the idea is where X marks the spot, meaning whether it's a fib or an additional trend line, that's going to be a major level or significantly more powerful level than where just one trend line is or one Fibonacci retrace or extension type move. All right. So we now have a shorter term trend line, which is a beauty, connecting the highs going back to June and July, all through these highs up. And that's right around, we talked about that level right up here, depending on where it is on the upslope when it hits, but anywhere between 68.75 and this white one is around 68.65. So we're now in about a 10-point zone where, again, markets likely will move up into, But the question is, again, can they get through? And again, like I said, you never know for sure, right? Markets can do anything they want. My job as a technician and what I found to be successful is being aware of the levels and being more cautious around levels. Whether it's hedging the portfolio that's long or taking on a few shorts to counterbalance longs in the portfolio or moving into some cash in the portfolio. I mean, there's lots of different ways to essentially be more cautious. But when you look at it, if you look at retail is putting more money in the market than ever before. There's more margin in the market. They're speculating more, right? It's become a casino where it's just everything every time it's hitting on red and red and red, and you just replay it, replay it, replay it. And again, what the charts are actually telling us is that you have to be more cautious up in this range. So if we go back to this, we have two trend lines. The question I guess I would ask is there another one? And this is where you break out a beautiful parallel. We're going to zoom out even more on this parallel to draw this parallel. And we're going to go all the way back. So now we've gone back to the lows here from October and November of 2023 for this trend line, which was a beautiful uptrend, by the way. You can see jumped off the line, back, jumped off the line, back, jumped off the line, and then finally broke down during the Liberation Day sell-off. But now what if we put a trend line here and we start connecting all the lows? Okay, so we now have a trend line. Notice right here, guys, a trend line from the low of COVID, March 2020, to the bear market low in October of 2022, to the same low here of October of 2023 that this new trend line starts, to the Liberation Day sell-off. Now, isn't that, number one, isn't that amazing that these lows all line up? Like literally 1, 2, 3, and 4 hits. Perfect trend line right there. I always find that fascinating because, I mean, think about, we always think, oh, this is random, whether markets are going to go up on Monday or Tuesday or Wednesday or Thursday or Friday or down. Is it arbitrary? Is it just random? How do people feel? What is the news telling us? But then you start to look at trend lines that connect all the lows and you're like, wait a minute, when there was panic here, we thought it was kind of just panic all out, but then the market stopped on a dime at that level in the liberation period sell-off. And that's fascinating to me. So let's go back to the charts. If we take a look at this and we drag a parallel up, number one, just notice here, high pivot, low pivot. Okay, let's drag it up a little bit more. Now look at this, low pivot, right? High pivot, right? And then we drag it up a little bit more. And then look at this, high pivot, consolidation against this trend line right here. And look, right here, all these highs right here align. And then what we do is we take it all the way up to this high right here. And we go in and we zoom in and look at what you're up into. All right. So now what we've created here is a remarkable 3 trend line zone. You have the parallel from 2020, the trend line from November or October of 2023, and we have a shorter trend line. Now, I want to be clear. It's very possible that there's additional trend lines here that I haven't even found. But for me, when I see 3, this gets my attention, right? And so essentially what we're seeing here is from 68.30 to about 68.75, there's a major hurdle. Now, if you're asking me if the markets can go up, the answer is yes. Why? Well, because we're not at these trend lines yet. Even the parallel, which is the lowest one, we're still about 30 to 35 points below on the S&P 500. So in the near term, the S&P can creep a little bit higher. All right. But once we get to about 68.30-ish, 35-ish, it's going to start slamming into these over and over again levels. And the question we have to ask ourselves, is the market powerful enough to break through these levels? And that's something that, again, we're going to find out. But what I do know in technical analysis is when you have parallels that go back this far, literally 5 to almost 6 years now back, and you have a trend lines that are short-term and long-term, all of these type of scenarios make me start to wonder if we're getting towards a point where the market, again, is just luring in the last group, getting people as leveraged on the long side through triple and double ETFs. All right. Are they getting every last person to think that the AI trade is never going to stall out before the rug gets pulled? Because remember, that's the human psychology conundrum. is that ultimately markets make you think it will never go down. And once everyone thinks that, once the bears are decimated, once every short has been covered, that's when the markets top out and collapse. And I think that's something that we always have to remember. And I've gone through this through many cycles, going back to the .com, the financial crisis, through COVID, all of these type of scenarios. Just like on the downside, when we were at the bottom in the financial crisis, it was all out pandemonium in terms of panic. Everyone thought the markets were just going to collapse and keep going down, and miraculously they bottomed out. Same thing happened in the bear market, right? People were very skeptical. Oh, the Fed's going to be doing this, and now, oh, the economy's not going to be able. And then, lo and behold, we turned around. And then COVID came. We flushed down. The world was ending from many news places, right? Many people thought that, and the markets bottomed out. And then, so same thing on the highs, right? At the high in 2021, the meme craze, Bitcoin at 69,000, it corrected down to 17,000, right? I mean, these type of things, it makes you believe that it will never end in that direction, and that's when it ends. And this is what we're watching here on the S&P. So again, the S&P short term, there is further a little bit more upside. Wouldn't be surprised if come Monday or Tuesday we're up a little bit more. But again, let's see how the S&P reacts at this mega wall zone of resistance, 85.30 to about 85.75. Now, if we close and confirm above that, I've looked. There is a few levels, but we probably grind up into year end, potentially another 5 to 7% if we can get through this level. This level is only about 1%, 1.2% away. So we're going to know soon. We're going to know probably in the next week or two, can the markets push through this level, or do they stall and start to correct? You guys have a great one as always. As always, folks, my job is to bring you what are the charts telling us, what's the human psychology of the situation, essentially data and charts, no BS. From me here at Verified Investing, you guys have a great, great rest of your day. Take care.